I'm Charlotte McLeod with the Investing News Network, and here today with me is Lithium consultant Rodney Hooper. Thanks so much for being here today.
Thanks very much for having me.
Great. And we are here at Minds and Money, where you just presented. You were speaking today about processing technology as a roadblock to investment in lithium. Can you outline briefly why companies struggle with that?
I think that one has to realize the evolution of the lithium industry. It started mostly supplying industrial applications like grease and ceramics, etc., and glass. But the future of lithium is centered around e-mobility and in particular EVs. And the requirements of the specifications for lithium chemicals to meet battery specifications and warranties in the EVs to be sold is at a far higher and stricter standard than in the past. So companies are having to evolve with tightening requirements and getting the impurities down. It's not a grade issue. You know, battery grade is one thing, but to be battery qualified, you need grade and impurities. And then other issues come into play, but those two are the most important. And it's really a case of the requirements of the lithium end users has changed materially.
So this is something that you've identified. Would you say it's also something that lithium companies are recognizing? Do they see this as something they need to address?
Absolutely, and you can see that in the bifurcation of lithium prices. So to the extent that you are not meeting battery grade or are producing a primary or industrial grade product, like we've seen with SQM being forced to sell into China, that price is $7,000 or less, whereas battery quality hydroxide into South Korea and Japan sells at more like $12,000 to $15,000. So they realize the demand for non-battery grade or non-battery qualified material has a very low growth rate. It's more like GDP. So it's a question of survival. If you do not meet the future specification requirements, you are going to struggle to stay in business.
So you mentioned this dual issue, and one part of it is, I imagine, having a good lithium resource. What makes a quality asset? If you're an investor, what should you be looking for just in terms of that asset component?
That's a complicated. It's an easy and a complicated question. So Albemarle has a spider web of all the things they look for a quality asset, like jurisdiction, size of resource, grade, etc. But ultimately, what is also important is who's behind the steering wheel, who's processing the material, and we've seen you can take very good assets and still not produce very good product. So it's hard to say what is a quality asset. I think you need to look at something that's comprehensive and what is a quality project and company. And that's what investors should look for.
Right, so it's not enough to have a good asset, you also have to have that processing capability. So when you're looking for that, I guess the combined package, then what things would you want to see?
Well, ultimately it's what's produced and what a company actually achieves. And as I say, if you absolutely cannot back or buy into a company that's not going to meet the future requirements of the industry, of the end users. Otherwise, that market is destined to be filled by a number of producers that are going to fall short. There might be a reprocessing industry that springs up, but the companies themselves are going to struggle because feasibility studies are done on the basis of reaching full nameplate capacity and producing all battery grade, and that really just isn't the reality that we're seeing on the ground. And feasibilities fall very short. The studies don't match up to reality, and they make for poor investments. So we expect that to be a hugely oversupplied market. So you do need to look at the end product and also customer history, customer interaction. There are people who have, some incumbents who have very good relationships and long-standing relationships that matter.
I think maybe something that ties in here, you can tell me if it does or not, is advances in lithium extraction. Where do you see potential there, and what would the timeline be? These things do seem to take longer than people might hope.
So we are interested in direct lithium extraction technologies that are coming up. To be clear, they aren't complete disruptors in the sense that the capital requirements are not materially less in most instances, and neither are the operating cost expectations. But what they have the potential to do with direct lithium extraction, most importantly, is remove impurities and produce a consistent product. But if you look at most of the players in the direct lithium extraction space, they are all coming out of lab scale testing and into a pilot plant, and those do take time, as you mentioned. So, what does work and what is helpful is, for example, a company like E3 that has the support of Livent. If they manage to get their pilot plant to produce, to expectation, then it's a question of scaling out rather than scaling up, because you are simply going to reproduce the same pilot plant over and over again to scale production. But E3, like other companies, they are expecting their timeline is 2023, as are some of the others. So you're unlikely to see a contribution before that time, but I think direct lithium extraction technologies could be hugely beneficial in the post-2025 scenario, when EV adoption and EV penetration really is on the rise and a significant amount of lithium is needed.
In your presentation, you pointed to integrated projects outside of Western Australia as having potential. Could you point to any examples, and are there any other project types that you're focused on at this moment?
So, E3 is one such example. As I say, it's earlier, but that's Alberta focused. The one that I do like, and I've recently written a report on, is Piedmont. It's American based. Again, I made it clear in the research report that I don't expect that it will majorly outperform. I expect it to be in line with its Western Australian peers from an operational perspective. However, they've got substantially lower costs in labour and electricity that typically in a dual process like a DMS and a flotation flow sheet represents 60% of costs. They've got cheaper electricity, they've got cheaper diesel, and they also have very generous depreciation and depletion allowances and a much lower tax rate and royalty rate. So it's not to say that I'm questioning at all the ability of Western Australia to produce something of quality. It's a question of the situation of input costs. Labour, electricity is very expensive, as is diesel, and there are high royalty rates and tax rates. So Piedmont is one. We have another company like LPI, and there are other brands that I do like because they typically sit on the very low end of the operating cost curve. So they are fairly resilient in down markets. So I like those. There's a couple of brand projects that I'm in favour of, but LPI has got a fully completed definitive feasibility study, and they're simply waiting on an environmental impact assessment approval. So there are other projects, I guess. Stable jurisdictions with a reasonable operating cost base and lower taxes is going to be a recipe for higher returns.
Okay, and just summing up a little bit some of the things that we've been speaking about, what would you say is the main challenge for lithium companies right now? It sounds like they're struggling a little bit to adapt to new specifications from the buyers. What would you say?
So, everything takes time, and when you speak to the guys who've had lots of experience in the lithium industry that goes back 25 years, they will always tell you what you need to be in this business is time and money, which is why I guess that's mining, isn't it? But, that's where I feel the incumbents sort of have larger and in some instances more diversified balance sheets. So it will take some teething to get it right, but again, ultimately, I think that that the industry can work towards reaching the specs that they need to. But again, your balance sheet needs to be fairly resilient. And we've seen, as I said, if you don't meet the requirements and you are forced to effectively dump your material into China, it's going to be a tough market for many. And worse, the spodumene concentrate producers that supply into the independent converters in China, are faced with the prospect of low prices in order for those customers to survive. So there's a lot of pressure in that supply chain. But I think as time progresses, you will see the quality companies move forward. I mean, one of them that I wrote about at the beginning of the year is Ganfeng. Joe Lowry mentioned on his trip to Asia that they are now seen as the gold standard for battery quality, I think, in the hydroxide. So there are companies that are nimble enough and will survive, and there unfortunately are, like in all industries, going to be casualties. It's a question of investors being very clear about the thesis and not buying into presentations and shiny spreadsheets, and taking a critical eye about genuine prospects.
And speaking about different supply chains, what do you see in Europe? What challenges do you see happening there as the supply chain develops?
So that's an interesting one, because what you've seen is different companies take different paths. So when you look at someone like Tesla and VW, who have decided to do a major push into EVs, they have looked to vertically integrate their supply chains and take a handle on things more. So Tesla has direct hydroxide contracts, so does VW. I see that BMW is looking to want to get into that. So to the extent that European auto companies decide to delegate the responsibility of battery sourcing to the battery cell companies, I think that's a risk. We've already seen earlier this year, I stand corrected, but I think it was Samsung who cut an order down to VW from 20 gigawatt hours down to 5. So, the OEMs understand that they need to get to $100 per kilowatt hour in order to make a margin and make EVs competitive. But as I mentioned in my presentation, you can lean on battery cell supplied and cathode suppliers, because volume for them, they could possibly cut margins or have technology improvements. But raw materials is going to be pushback from the other side of the chain. That is the risk for the European companies, because China dominates the chemical market. There is no chemical conversion capacity in Europe. There's talk about now, I see AMG and possibly others sending some kind of a technical carbonate across and purifying that in Asia. And as you know, Orocobre has got Naraha they're going to do in Japan. But we're talking about a fractional amount on a demand base that's growing at unbelievable rates. So I think at some point will Europe ease up on mining restrictions and have a go at looking at domestic sourcing and at allowing further expansions into the cathode, and along with what we already know on the cell side is something we shall see. It looks like they're leaning more towards it. At the moment there's no sense of urgency because there is, inverted commas, a lithium oversupply, but I'm not even going to get into that. Quality lithium is in short supply in my opinion, or will soon be. But when the market really tightens and there's an arms race, as Benchmark Minerals calls it, to get batteries, I think Europe may change its tune.
Just to wrap up, we do hear a lot about the positive long-term outlook for lithium. Are there any threats to that outlook? What would you say? So
we've seen, what we call it is the carrot and the stick in terms of incentives for electric vehicles. So you have forced CO2 emission standards, China 6 coming in with a new energy vehicle policy, so forcing manufacturers to get into the lithium business, but forcing people to sell something is not really helpful if they don't have buyers. And at the moment, the fact of the matter is electric vehicles in the smaller sort of mass market segment, they are more expensive than internal combustion engine vehicles, so you need the carrot as well. And Germany has just, to all intents and purposes, doubled some of its direct buyer subsidies. And they're giving the industry, until 2025 to get its act together, get prices down and make a margin. China this year decided to pull the rug on some of the subsidies. Yes, it was highlighted. A lot of people like to say we all knew. But the reality is that, electric vehicles are still more expensive than internal combustion engine. And in a price-sensitive mass market segment, buyers are willing to do the right thing, but they're not willing to pay over the odds to do it. So We know the upper end market where Tesla plays and where all of these new products are coming in. On an all-in, full-life basis, they are competitive because there's a lot of branding, intangible costs to buying a car with a brand name as opposed to raw manufacturing margins. So if China eliminates all subsidies next year, that's likely to put some strain on. That could be a bit of a bugbear. We know that Europe is expected to go over 1 million electric vehicle sales next year. That, of course, will help. It's growing. Their last sales number was up 76% year on year. I don't know that that's enough. But model choice, you look at Tesla, it's just released the Cybertruck. For better or worse, it's an odd design, but it seems to be getting potential deposits, if not orders. You've got the Model Y coming. You've got the Ford F-150, all electric. You've got GM talking about entering in. You've got Rivian. These are massive pickup trucks. I mean, the Rivian comes in the 135 or 180 kilowatt hour choices, which is an enormous battery pack. So there are some mitigating new models coming in. You've seen that in Europe. That could help things. But China completely eliminating subsidies could see, by 2021, you could see China in second place behind Europe if they're not careful. But the government has a way of balancing out, but that's a real threat. On the other side, and I know this will sound to listeners like very contrary to what they keep hearing about the prices, but I wrote an article about how if VW and Tesla meet their sales targets in 2023, as does China, that potentially we could see no other available lithium for any of the other manufacturers. So if the model launches come, I showed in my slideshow, there's 5.5, 6 times as many models coming out, bigger battery packs. A shortage is coming, but a China subsidy elimination could set things back a little bit.
Okay, well, thank you so much. I think we'll leave it there. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rodney Hooper.